Welcome to your daily market update for June 29, 2025. The markets are entering the final stretch of June with strong momentum and rising optimism as investors brace for a week packed with crucial data, earnings surprises, and geopolitical developments. As of the latest close, the S&P 500 continues its steady ascent, pushing toward new highs, currently trading around 614.91, up nearly 0.5% for the day and posting solid gains over the past 5 days. The Nasdaq and Dow are also holding firm, showing a balanced but bullish market environment supported by strong earnings, fading inflationary pressures, and dovish central bank commentary. Friday's rally was fueled by strength in tech megacaps, a theme that has persisted throughout 2025. Names like Nvidia, Apple, Microsoft, and Meta continue to outperform, buoyed by persistent demand for AI-driven solutions and robust cloud infrastructure revenues. Nvidia alone added over $60 billion in market cap in a single day this week, driving the tech-heavy Nasdaq into uncharted territory. Investors are clearly embracing the narrative that AI isn't a passing trend but a fundamental reshaping of corporate operations and consumer experiences alike. This shift in sentiment is reflected in the upward revisions from Wall Street analysts who are now projecting full-year EPS growth for S&P 500 companies to approach 12%, well above the 7% consensus forecast from the start of the year. While technology remains the centerpiece of the 2025 rally, it's not the only sector drawing attention. Financials, particularly regional banks, have staged a quiet comeback in recent weeks. After being battered by last year's rate volatility and liquidity fears, many mid-sized banks are showing stable net interest margins and stronger than expected loan performance. A few standouts, including Fifth Third Bancorp and Huntington, beat Q2 estimates and raised forward guidance, signaling a sector that's regaining investor trust. Energy stocks, on the other hand, have had a more mixed journey. While oil prices surged earlier this month due to geopolitical tensions in the Middle East and tightening inventories in the US, they've since moderated. West Texas Intermediate crude is hovering around $75 a barrel, slightly down from the month's peak. The dip has taken some wind out of the sails of oil majors like Exxon and Chevron, though natural gas-related names such as Cheniere and EQT have performed better thanks to increased European demand and summer heat waves. Speaking of weather-related factors, climate and infrastructure plays are drawing more institutional inflows. The recent heat dome across the southern United States is pushing up electricity consumption, spurring activity in utilities and renewable energy producers. Companies focused on grid modernization, battery storage, and electric vehicle infrastructure are in focus again. Tesla's upcoming delivery numbers, scheduled for midweek, will be closely watched not just for raw figures but for commentary on demand trends in China and Europe, two markets where competition is heating up. China remains a wild card. While the Chinese economy has shown pockets of strength this quarter, particularly in services and tourism, the industrial and property sectors are still lagging. The People's Bank of China recently hinted at targeted stimulus to support small businesses and job creation, a move interpreted by some as a shift away from broad monetary easing. Equity investors remain cautious, with the Shanghai Composite mostly range-bound, though US-listed Chinese tech stocks such as Alibaba and JD.com have rebounded modestly from their May lows. Trade relations with the United States remain tense but stable for now, with the upcoming July 9 deadline to extend or end current tariff exemption looming as a key risk event. Across the Atlantic, European markets are also on a steady upward path. The Euro Stoxx 50 and Germany's DAX are both up nearly 10% year-to-date, led by industrials, luxury goods, and financials. Inflation in the Eurozone continues to decline, with the latest data showing headline CPI at 2.3% and core inflation easing to 2.1%, opening the door for a possible European Central Bank rate cut later this summer. The euro has held steady against the dollar, trading near 1.9, with currency markets in a wait-and-see mode ahead of the next round of US employment data. Turning to bonds, US Treasury yields remain in a tight range. The 10-year sits near 4.27%, reflecting a balance between modest inflation expectations and a Federal Reserve that remains cautiously patient. Fed Chair Jerome Powell reiterated this week that while inflation has eased substantially, the Fed wants to see more data confirming the trend before making any rate cuts. Markets are currently pricing in about a 21% chance of a rate cut in July and a 52% chance by September, according to CME FedWatch data. Short-term yields remain anchored, with the 2-year Treasury at approximately 4.59%, maintaining a mildly inverted curve that reflects lingering growth concerns and rate uncertainty. On the economic data front, investors are preparing for a pivotal week. The ISM manufacturing and services indexes are due early in the week, followed by ADP private payrolls, weekly jobless claims, and then the big non-farm payrolls on Thursday. Last month's jobs report showed a cooling but still resilient labour market, with unemployment ticking up to 4.0% and wage growth holding steady. Economists expect around 180,000 jobs added in June, a figure that would reinforce the soft landing narrative and keep equity markets buoyant. Anything significantly below or above that could jolt bond yields and equities alike. corporate earnings are entering a quiet period ahead of the next season, but a few key names will still report. Next results are expected Tuesday, with analysts watching international sales trends and inventory management. Micron Technology's report, scheduled for Thursday, will offer a crucial look into memory chip demand and AI server trends. Investors are also eyeing delivery numbers from Tesla, NIO, XPeng, and BYD for insight into consumer sentiment and competitive dynamics in the global EV market. In commodities, gold remains well supported, trading near $23.30 an ounce as geopolitical tensions and a weak dollar lend support. Silver has also climbed, now above $30 an ounce, with industrial demand providing a tailwind. Agricultural commodities are mixed, with corn and soybeans lower on improved crop conditions, while cocoa prices continue to soar due to supply constraints in West Africa. Copper is rebounding slightly, supported by demand optimism tied to infrastructure and clean energy build-outs. Crypto markets are showing resilience after a volatile first half of the year. Bitcoin is holding above $63,000, consolidating after a post-halving rally in April. Ethereum is steady near $3,400, with layman's to scaling solutions and institutional adoption supporting the ecosystem. Altcoins remain mixed, with Solana outperforming and XRP under pressure due to ongoing regulatory scrutiny. The SEC's evolving stance on spot ETFs and staking is shaping investor sentiment, and the upcoming ETF inflows data on Monday could set the tone for the week. In Washington, the Senate is expected to take up a tax and spending proposal ahead of the July 4 recess. The plan, which includes modest corporate tax hikes and expanded child tax credits, faces an uphill battle but could impact market sentiment depending on the level of partisan support. Investors are also closely watching developments in the EU as China tariff negotiations. The July 9 deadline marks the end of the 90-day reprieve announced earlier this year, and failure to reach a new agreement could trigger renewed tensions and market volatility. Investor sentiment remains broadly bullish, with the RS Sentiment Index showing 48% bullish, 26% neutral, and just 26% bearish. Market breadth is improving, with over 68% of S&P 500 stocks now trading above their 50-day moving average. The VIX, Wall Street's fear gauge, remains subdued around 16, indicating relatively low hedging activity and suggesting traders are not expecting major near-term turbulence. Still, portfolio managers are urging caution, reminding clients that summer markets can be unpredictable, especially with thinner volumes and event-driven catalysts. Retail participation remains high, especially in options and short-dated derivatives. The rise of zero-day to expiry options continues to fuel intraday volatility and gamma-driven moves. While institutional investors are net buyers of equities, retail traders are increasingly deploying leverage bets on tech names, a pattern reminiscent of late 2021. Some analysts warn of froth, but others argue that the current rally is healthier, underpinned by solid fundamentals, strong earnings, and declining inflation. As we approach the midpoint of the year, the overall picture is one of cautious optimism. US equities are on track for their best first half since 2021. The bond market is stabilizing, the Fed is on hold, inflation is moderating, and the economy continues to hum along without overheating. The challenge ahead lies in navigating a complex web of data releases, political developments, and sector-specific stories that could change the narrative quickly. But for now, the bulls are clearly in control, and investors are riding the momentum. So, as we head into the final days of June and prepare for a new quarter, all eyes are on the economic data, corporate deliveries, central bank guidance, and geopolitical headlines. Stay informed, stay agile, and keep your focus on the bigger picture. Whether you're a trader looking for short-term setups or a long-term investor managing strategic exposure, the coming days will offer both opportunities and risks. That's your full market picture for today, June 29, 2025.